Hi guys, Mark here from the Pattern Trader. It is Thursday, August 20th, and in front of us we have a chart of the euro versus the British pound. As you'll recall, yesterday we put a buy stop in the British pound at 70.96, just above this high right here. Uh, the reason we did that is several-fold, and I'm going to use this chart as a way of giving you guys a bit of a treat in terms of really letting you into my trading strategy, my methodology, how I analyze the markets. I'm going to go through that thoroughly. This is a good price chart to use as a demonstration of that. This chart kind of reminds me of a silver trade I did back in 1981, a long time ago, where I, can see these patterns in my sleep. And it was the silver market. The market was trading around the $9 area at the time. And just like this chart, silver had made a pronounced low. It bounced off the low, and then it was trending back to the previous low. And I set a buy limit order, which is a little bit different than what I typically do today, right at or about the previous day's low, or I'm sorry, the previous low a couple of weeks before that, right around about the 892. Even though it was a long time ago, I can remember that trade like it was in my sleep. And I was a bit of a gunslinger then. I had about 15 grand left to my name, and I was so positive of what I was looking at that when silver was retracing back to that 890 area, I snuck my buy limit in there. And then when I saw the price action starting to confirm what I was looking at, I got very excited, and I also got very aggressive. And every day that silver opened, I bought more and more and more, uh, kind of thinking that I knew what I was looking at, and the price action was also confirming that. I ended up running that $15,000 to about $280,000 in about a 30-day period of time. So I'll never forget that trade. And every time I see one of these double bottoms, I know what I'm looking at and I know what the implication is. So let me kind of backtrack and go through exactly my thinking, my analysis, what I look for today. It's a little bit more sophisticated. I use much more confirmation than I did back in the day. And of course, I'm not as reckless. I usually put anywhere from a 0.5% to 1% per trade. If there's a trade I really like, I may go up to 2% per trade. But I basically would recommend, for the most part, keeping your risk level to 0.5% to 1%. There's plenty of money to be made. The game is really won in the area of the risk management. So you don't have to go for broke on every trade, and um, you know we can make a lot of money, 5 to 10% a month, just risking a 0.5%. So as I showed you last night, what I started key on and why I put the buy recommendation last night was because of the emergence of this double bottom here. Let me just draw all this in so you can see exactly what I'm talking about here and be able to follow me uh, right there. So that's the double bottom that we were looking at. Now that's the first part of my criteria. The second, and I'm going to go through this in detail, I'm going to draw it out for you. The second is what I call an insurance day bar. I've kind of coined this phrase because this is a bar that I look for once I see the first part of my analysis. So the first phase of what I look for is the phase or the direction of the market. So this market has been more or less in a downtrend for the last several months. And then, to the untrained eye, it basically looks like it's just been in a waffling kind of condition, and it doesn't look like there's much there. But as I said, what I'm looking at are these two price points at about the 69.50 area that then began to give me an indication that this market was turning from a bear market to a bull market. So again, the first thing that I look for is a trend or phase of the market. So if the market is trending or phasing, it's, I'm sorry, if the market is trending, it's very easy to see. If the market's going in one direction, it doesn't take much of a genius to figure out what's going on there, and we have a method about hopping on trending markets. If the market is turning from a bullish to bearish or a bearish to bullish, there are going to be several patterns that emerge. It can be an inverted head and shoulders, it could be a double bottom, and in fact we have the presence of both here, because if you look closely, we have an inverted head and shoulders. Here's the one shoulder, the left side, here's the head, and here is the other one. So now we have a double bottom and an inverted head and shoulders. So we have two bottoming price patterns that are in play in the euro versus the British pound. So as I indicated, the first step of my analysis right here is item number one, is that I identify the trend or the phase of the current market condition. Is the market trending up? Is the market trending down? Is it sideways? Is it turning from bullish to bearish or bearish to bullish? So that's the first element and consideration in my analysis. Once I've determined that there is a trend or a pattern in play, I don't just jump in the market. I look for a second level of confirmation, which again I've coined an insurance day bar. And we see the insurance day bar right here. This is the inside day bar. So an insurance day bar, to me, it comes in two forms. One is a key reversal. This is a market that makes a new low and closes on the high, something like you've seen here. Or it is an inside day bar, like we see right over here. An inside day bar, as you can see, which emerged yesterday, is where the low and the high is within the low and high of the previous session's high and low. So again, an insurance day bar basically puts the risk reward in our favor. So again, I just don't jump in anywhere. I look for the emergence of a key reversal or an inside day bar. And then I have a third level of criteria. So once I've identified the phase or the trend, and we've identified our insurance day bar, I have a third level of confirmation that is required in order for me to get into a trade. And that is what I call the pending order or resting order entry execution strategy. So basically what I do is, once I've identified the insurance day bar, in the case of a buy signal, I look to put the buy stop directly above the previous session's high. In this case, the previous session in the euro versus the pound was 70.95. So we put our buy stop 1 pip above that at the 70.96 area. And as you can see from the price action today, when this order was triggered, we immediately got put into this trade. So this is exactly what I look for. If my analysis is good, the market should just explode in our favor. And that's exactly what happened here. So the market is currently trading at the 70.60 area right here. You can see, sorry about that, wrong pencil, the 60, it's trading at 71.60. We got in at 70.96. We're looking at a 64 pip profit already in the euro versus the British pound. That's a nice profit in and of itself, but to me that's just the beginning. So I don't just jump out, when we have nice profits. I have, specific objectives. Frankly, we're just basically trading at the neckline now. So really the confirmation of this whole inverted head and shoulders double bottom pattern will finally be triggered right above the neckline here, which comes in right about today's market action. So I think the first level of resistance we'll see is going to be right around the 72.25 area, and then the next major resistance will come in at around 73.50 and 74. And based on what I'm seeing now, since this is a double bottom, by implication, this should be a bottom. And I fully expect that prices should start going up to this area or even greater. So I'm going to look to hold a core position for the long term. I may start getting out of some of the partial positions just on a risk management basis, but I'm going to be holding this for an extended period of time, looking for an extended move, and this is how we can make 2 to 5% on an individual trade. Now, going back to my strategy, once I've placed the buy stop, I strategically place a stop loss order that's anchored to the close right here. So you can see the close is around the 70.90 area. So when I put my buy stop at the 70.96, I simultaneously entered a sell stop that is anchored to the previous session closing price of 70.88. I typically put the stop loss 20 to 30 pips below that. You know, sometimes we can get some market noise where the market breaks higher, breaks lower, and then breaks again. I don't want to be prematurely stopped out, but having said that, I also don't want a situation where the market goes in our favor and then all of a sudden comes back. That's not something that we want. If our analysis is good, the market should immediately just break and go. So the previous session's close was 70.88. I put the sell stop 20 pips lower at 70.68. And so basically we're looking at a situation now where I have a 28 pip stop loss for what could be a 300 to 500 pip move here. So not bad. I expect to at least get a 5-to-1 risk reward on this trade, but it could be as much as 10 or 20-to-1. So that's an example of a very powerful trade setup that we can make 5% or more on a single trade. These don't come along every day, but we typically can identify 1 or 2 of these a month. And by getting a large gain on an individual trade, obviously it takes care of a lot of losers along the way. This fifth element that we talked about, my take profits are somewhat arbitrary. They're tied to market conditions. If we're in a pretty choppy condition, I'm going to be looking for a 1.5 or 2-to-1 risk reward. I'll just put that as a take profit on an arbitrary basis. In something like this, where I do think we're tracing out a double bottom that could extend for days, weeks, or even months, I'm going to be watching the market to tell me where to get out. And again, you know, my whole philosophy is that the market puts me in and the market takes me out. I don't really overlay any fundamental opinion of my own. I look at market action, price action, pattern analysis to get me in and to get me out. So just like you see a key reversal here, where the market made a new low and then closed in the opposite direction, which gave me an indication that this was a turn in the market, I would similarly look for a market action like this to get out of some of the positions. So if we had a day that basically you trended higher and then we went lower on the day and we closed like this, then that would indicate that there was somewhat of an exhaustion and I would start peeling out of some of the positions. So until then, I'm going to stay in this market for as long as it will have me. So that basically encapsulates a lot of my thinking, a lot of my analysis on how we identify profitable trades. And folks, this works over and over again. The markets make these recurring patterns on a recurring basis. You have a huge double top here that took you tremendous price levels lower. And we see these recurring price patterns again and again in every market. Currencies, pork bellies, gold. You can use this analysis to trade your stocks. It's very basic. You know, you can see you don't need any complicated indicators that don't work. We just have a clean price chart with just price and time. You don't need anything more than that. If you just understand a couple of patterns, what a double bottom looks like, what a double top looks like, what a descending wedge looks like, you can make a ton of money. But as I've indicated, I don't just look for one or two patterns and then just jump in. We have 2 or 3 confirmations that we are required to have our trade initiated. The final confirmation is when the market puts us in, and then it should just explode from one level to the other. So anyhow, that's our analysis for today. It is Thursday, August 20th. I wish you a healthy and prosperous trading day.